You think markets move because millions of people click buy and sell. That's the story. Here's the uncomfortable truth. Sometimes it's just one order, one decision, one line of code, one trade so large it quietly rearranges the battlefield before anyone else realizes a war has started. And by the time thousands of traders notice what's happening, they're already trapped. Let me show you how that works. Not in theory, in real market behavior, in a way that's probably already happened to you, right now. Because this matters more today than it did 5 years ago. Liquidity is thinner, algorithms are faster, and the distance between normal trade and crowded disaster has collapsed. So let's start where every trap starts, with something that looks harmless. A calm chart, tight candles, low volatility, the kind of market that makes traders feel smart. This is where confidence grows. Retail traders see stability and think safety. They see small moves and think control. They start scaling in, little positions, stops just below obvious levels. Everyone sees the same structure: support, resistance, range. It feels almost polite. Now zoom out, away from the chart, away from the candles. Somewhere else, someone sees the same market very differently, not as a chart, but as a pool of orders, stops, limit buys, margin positions, liquidation levels. They don't ask where will price go, they ask where is everyone vulnerable. And then comes the large order. Not slammed into the market, not obvious, not dramatic. Placed slowly, quietly, often broken into pieces. Because the goal isn't to move price yet. The goal is to prepare price. This is the part nobody explains. Large players don't trade into liquidity, they build it first. They need people on the other side. They need confidence. They need participation. So price stays calm, almost boring, just long enough for traders to commit. This is why the trap doesn't feel like a trap. It feels like opportunity. Now let's talk about the math hiding underneath. Imagine 10,000 traders, each risking small amounts, stops clustered in obvious places, below range lows, above range highs. Individually, they don't matter. Together, they're explosive. Because stops are not exits, they're market orders waiting to be triggered. And market orders don't ask for permission, they demand liquidity now. So when that large order finally acts, it doesn't push price, it removes support. One heavy sell absorbs the resting buy orders. The book thins out. Price doesn't fall smoothly, it drops. And that drop triggers stops, which become market sells, which hit an already thin book. That's the cascade. It feels sudden, violent, unfair, but it wasn't sudden at all. It was engineered. Here's the irony. The large player didn't need to be right about direction. They only needed to know where traders were wrong together. This is why you'll often see price snap back afterward. Because once the stops are cleared, once positions are liquidated, once panic selling finishes, liquidity returns, and price stabilizes. Sometimes it even goes back exactly where it started, which is the cruelest part. Because from the outside, it looks like a fake move, a wick, a stop hunt. But from the inside, accounts were wiped. Now zoom in on the timeline. This doesn't happen in seconds. It happens over hours, sometimes days. Phase 1, accumulation of expectations. Traders build narratives. Range-bound, compression, breakout coming. Phase 2, positioning. More leverage, tighter stops, crowding. Phase 3, silence. No news, no catalyst, just patience. Phase 4, the order, often during low liquidity periods, late sessions, overlap gaps, moments when fewer participants can respond. Phase 5, cascade, stops, liquidations, slippage. Phase 6, reversal or stabilization, after the damage is done. Most traders only see phases 4 and 5. They miss the setup entirely. And that's not their fault, because the chart doesn't show intent, it only shows outcome. Here's where hype enters the picture. You've heard it before. Institutions are hunting your stops. Smart money is manipulating price. That framing is dramatic and mostly useless. The reality is colder. Large orders don't care about you. They care about execution. They care about getting size filled without moving price against themselves. If 10,000 traders happen to be standing in the way, that's not personal, that's convenient. Now here's the uncomfortable math. A single large order doesn't need to equal the size of all those traders combined. It only needs to hit first. Because once stops trigger, the market does the rest of the work for free. That's leverage you never see on your screen. And it explains something many traders can't reconcile. Why being right still loses money. You caught direction, you read the macro, you timed the range, but your exit was predictable. And predictability is liquidity. This is where the system quietly rewards skepticism. The traders who survive aren't smarter, they're less obvious. They don't place stops where everyone agrees. They don't size up and calm markets assuming safety. They don't confuse quiet with stable. They assume calm is preparation. Now zoom out even further. This mechanism isn't limited to crypto, or stocks, or futures. It shows up anywhere orders cluster. FX, commodities, even bond markets. Anywhere leverage meets thin liquidity, large orders gain asymmetric power. And that power has grown. Because markets are faster, participation is wider, and many orders are automated, emotional, or both. Which creates a strange modern irony. Technology promised efficiency, but it also made herds move faster. And herds are easy to trap. So the next time price collapses out of nowhere, ask a different question. Not what news caused this, but who needed liquidity right here? Because often nothing broke, nothing changed, nothing was revealed. A single large order just finished setting the table, and thousands of traders unknowingly paid for the meal. So here's the thought I'll leave you with. If markets can move violently without news, without fundamentals changing, without warning, then how much of what you call price action is actually price, and how much is just the echo of other traders being forced out before you? That's not a comfortable question, and the market has no incentive to answer it for you.